Chapter 11, Investing Basics and Evaluating Bonds. Here are the learning objectives for this chapter. So why begin an investment program now? The sooner you start an investment program, the more time your investment have to work for you. Investment goals must be specific and measurable. Here are several factors you should consider before making your first investment. First, pay your bills on time. You don't want to start investing if you're not in that habit of getting your bills paid on time. Paying bills on time avoids negative consequences. Work to balance your budget. Your income should be more than your expenses. If they're not, you need to work on making that happen. Manage your credit card debt. It is very easy to get into trouble. Also, start an emergency fund you can access quickly. Remember, we want about 3 months of living expenses in that emergency fund. And then have access to other sources of cash for emergencies. So I have Checkmate, or it's an overdraft line of credit through Isabella Bank of $1,000 for overdraft protection. So that's there in case I need it. If something comes up and I need money, I can access that and then pay it back as soon as I have money, so that so I'm not having to use a credit card or something like that. Here are ways you can obtain funds to invest with. Pay your bills and pay yourself. Take advantage of employer-sponsored retirement programs. Participate in elective savings program. Make a special savings effort 1 or 2 months each year. Take advantage of gifts, inheritances, and windfalls. The rate of return and length of time your money is invested do make a difference. A 20-year-old investing $1,000 a year, just $19 a week, will have more than $42,000 by the age of 40. So real estate, CDs, bonds are safe. They're less risky investments. Stocks are less safe. They're high-risk investments. Will your investment yield higher returns than inflation? Investment value may change with interest rates. Business failure risk. Will the corporation fail? You don't want to invest your stocks, or you don't want to invest by buying stocks or bonds from a corporation that's on the brink of failure. Or market risk. Is my cash safer in a risk-free account? So investment growth. High growth investments rarely pay dividends. So my kids have investments and they're in high growth investments. They don't pay dividends, but there's because those accounts will be open a really long time. I put them in high growth funds so that they could grow a lot. And then investment liquidity. Can I turn investment to cash quickly? So whenever we talk about money being liquid, that's just how quickly you can turn it into cash. So if you have money in a savings account and you need that money back out, you can get it out the same day you put it in. But if you buy stocks or mutual funds, or you have money in investments, you have to wait at least 3, but sometimes 4 days to be able to get that money out for an emergency. Real estate is not liquid at all. So if you're buying houses that you're renting out, or houses that you're fixing up to sell, you can't sell a house right away for the most part. So real estate or property is not liquid, but money market accounts are liquid. So money market accounts are checking accounts and savings accounts together. So your money that you have in there is invested, but you can get that money out quickly. Usually you have to have a large amount always in there, like maybe a $5,000 always in that account, though. You can't open a money market account without a large amount of money. Factors that reduce investment risk. On average, stocks have returned close to 10% a year. Now, stock values will go up and down all the time. But over the long run, if you look at your stock value today and then again in 10 years, you'll probably, or on average, see a 10% increase. You don't want all of the same types of investments. You will want to utilize many types to avoid a serious consequence if one type of investment fails. What diversification means is that, let's say you have a large amount of money to invest and you decide the automobile industry is doing great. I'm going to invest all my money into automobile stocks. Well, a few years ago, the automobile industry was not doing great and people that had stock were losing a lot of money. So you wouldn't want to invest in one type of industry or one type of investment because if something goes wrong with that one type, you're going to lose a lot of money. So let's say you have $10,000 and you want to invest $5,000 in automobile stocks and the other $5,000 in bonds or in all different kinds of other stocks. That would be diversification. So if something goes wrong with one, you have something going right with the rest of them to make up for that. Check out this table comparing different types of investments. Many personal financial websites have asset allocation calculators or financial advisors can assist you in decisions. Rule of thumb is the younger you are, the riskier investments. Inversely, the older you are, the less risky investments you should have. Here's a visual of the investment pyramid. Successful investors continually evaluate their investments. These are valuable steps to manage an economic crisis. Our family went through these steps during the COVID shutdown. You know, first you want to maybe add to your emergency fund. Know what you owe, identify any debts that really should get paid so that you can eliminate some of those payments coming out, reduce spending, notify credit card companies and lenders if you are unable to make payments. Sometimes they'll work with you. Monitor the value of your investment and retirement accounts, and then consider converting investments to cash to persevere the value, or preserve the value. Bonds are essentially an entity, government or corporation, borrowing money from the investor for a period of time and then paying it back with an agreed upon amount of interest. So you're normally not going to earn a ton of interest on bonds. However, you're always going to get interest on bonds unless that government or that corporation goes bankrupt during that time. You will get your money back plus interest. So it's really a safe way to invest. These bonds can be issued with many different minimums, lengths of times, discounts, and other attributes. Government bonds have known to be the safest. However, they pay out the lowest interest. Here's a table describing treasury bonds. There are even local government bonds that can be purchased through Mount Pleasant or your township, used to fund its projects. These can be paid back in different ways. We are going to skip this slide. We will not cover this. Bonds can also be used to finance corporations, finance a corporation's ongoing business activities. Every corporate bond will have these 4 indicators: face value, maturity date, bond indenture, and trustee. Trustees are appointed to protect the investor. Many reasons corporations sell bonds. They could sell them to raise funds for major purchases, to fund ongoing business activities. When difficult or impossible to sell stock, if consumers just aren't buying stock at that moment, like maybe what we went through with COVID, people weren't investing. To improve financial leverage. Interest paid to bondholders is tax deductible for the firm. In the event of bankruptcy, bondholders have a claim to the assets of the corporation prior to that of stockholders. So if a corporation does go bankrupt, any money they do have will go to bondholders before stockholders. Corporate bonds can be backed by corporation or backed by a mortgage. Other types of bonds are convertible bonds, high-yield bonds. Sometimes bonds can be bought back early or bought back in installments or at different dates. So why investors purchase corporate bonds? For that interest income. Usually corporate bonds have a coupon, which just means a certain amount that they'll pay you. It's like paying that interest out throughout the year. The dollar appreciation of bond value, the bond repayment at maturity. So I would suggest going through a financial planner first. Then if you decide to purchase bonds, I would talk to a financial planner about that. The internet has all types of bond info available. Here are all kinds of links that can offer you some bond info. And here's a table that describes ratings. The next 2 slides, I just want you to ignore. And then after that, we just have some summaries. So we're all set. Thank you.